Hey everyone, sorry to interrupt, but this is the cheesy podcast bit that gets on everyone's nerves, but it's really important to me. Please, if you can like the channel and also subscribe, it helps me a lot to get the best guests in the world for you guys. So click like and subscribe. Appreciate it. Thanks.
Hi everyone, I'm Raoul Pal, and welcome to my show, The Journeyman. The Journeyman, as you all well know by now, is my journey into the nexus of macro, crypto, and the exponential age of technology. I try and move all of these topics along so you can see that they're all part of a bigger picture. Today, it's time to get back to crypto, which I know many of you are involved in. As you know, I think it's the biggest macro opportunity of all time, and it's still all to play for in 2025. I'm very privileged because I do a number of different things. Not only am the CEO and co-founder of Real Vision, but also my research service, Global Macro Investor, I've been writing for 20 years. And it's become a very famous institutional research service and maybe the best performing in all history, which I'm incredibly blessed at. But I also own an asset management company, Exponential Age Asset Management, where our core product is a fund of hedge funds that are crypto hedge funds. So we get to speak to the greatest crypto hedge funds in the world. And somebody I've got to know over time, who's one of our great managers, is Richard Galvin. Richard Galvin is a great thinker. He's a technologist, an analyst, but now, and for many years, is one of the larger hedge funds in the space. So I always like to catch up with Richard and figure out what's going on and where the future trends are, where we are in the cycle, and what opportunities we should look at. So let's sit down with Richard Galvin.
Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together.
Richard, always great to see you on Real Vision.
Thanks for having me back.
Not at all. And we were just talking about it off camera. It's the middle of your summer holidays, so...
It is.
I appreciate
it's been a hot
it.
few weeks down here. It's got the first rain in 3 weeks. So,
how hot is it? How hot is it?
It's sort of low 30s in Sydney.
Oh wow! Okay, that's hot.
Yeah,
that's hot. And you're wearing a jacket for us.
Oh yeah, got to look formal. Got to look formal.
So, just as ever, let's just quickly remind people what you do, and then we'll dig into a whole bunch of stuff. I know I haven't caught up with you for a while, so it's always good to catch up.
Sure, I'm executive chairman and CIO of DACM. We're a crypto native investor. We started the firm back in 2017. Before then, basically spent 20 years as a tech banker. We're an investor. We've got material money and liquid long-only funds and also an early-stage VC fund. So we're not traders. We're long-term believers in the growth of this tech and the value that's going to return to the tokens that are the core asset within it. And so we buy and hold concentrated positions in those tokens and look to make the outsized returns that crypto can offer if you smooth out the shorter term volatility.
Yeah, exactly. And just as a disclosure, XPAM, the business that I co-founded and the CEO are an investor in DACM, just so everyone's aware. But Richard's always one of my favorite people to speak to. So Richard, hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now. Last year, what were your main token allocations? What was your thesis? And then we want to see how it's changed over time because things do change. But last year when you were coming in, let's say this point last year, how were you thinking? How were you positioned?
Yeah, I think as a firm, we've generally run pretty low allocations to Bitcoin, relatively low, much lower than, say, its market dominance figures. Coming into last year, we had probably our highest allocation to Bitcoin we've had since about 2018, late 2018, early 2019. It just had such good tailwinds, right? Like things were just, piling on top of each other in terms of ETF demand. Other factors that just continue to sort of push it through and get that penetration amongst particularly the investor market, right? We also had what I'd say is a broader range of alts across both, particularly across AI and DeFi, which we've refined through the year, and we've started to sell down Bitcoin, which has been somewhat of a widowmaker trade over the last 2 years, but we have started to sell down Bitcoin over the last 2 months. And we have started to sell down since mid-year materially our exposure to what I'd say is protocols. So when we look at the space, we think there's kind of 3 distinct buckets of assets. You can kind of put Bitcoin as its own asset because I think it's a pretty unique kind of thing, right? It's kind of a protocol and an app all in one, and it serves its own kind of purpose and valued in its own way. Outside of that, we think there's really 2 sort of baskets of assets. You've got applications on one side and you've got protocols on the other. Applications being built on top of protocols, generally, or sometimes having their own. We've skewed our portfolios materially towards applications over the last 6 months, as we think that's the most compelling trade as we look to the medium, longer term, both in terms of where we think the tech is from a maturity perspective and putting our investment hat on where we think the relative values are when you look at those two parts of the sector on a bottom-up basis.
So talk me through how you see protocols, and then we'll go through apps. But talk us through the protocol landscape. We've got some new layer 1s, layer 2s. Just talk us through your kind of thesis around that.
Yeah, I think when we look at failure, and look, to be upfront, sort of as a disclaimer for this discussion, you need to look at things in 2 ways, right? We're an investor, so ultimately, we're looking at growth versus value as well. So, a lot of the things I'll talk about today can still grow and be successful and have heaps of users and all that sort of stuff. But we're an investor, and most of the listeners on you want to
maximize returns.
Yeah. But we're going to say, look, is that growth outlook, is that prospective outlook at the right price, or is there too much in that price? So just to put that as a caveat before I start to sort of launch into what's might sound negative about a whole bunch of different stuff. Whole bunch of different stuff. When we look at the protocol space, we've seen developments there, to be honest, not dissimilar to any disruptive tech when you look back, to be frank, over 100 years. The first thing that disruptive tech builds out is the infrastructure layer. And that makes a whole bunch of sense, because you kind of need that, of course, to start sort of building applications and other use cases on top of. But there's a long history of that process getting extremely crowded and overfunded. You can go back to the railways in the US, right? Like huge returns made in the early days, but then huge overfunding and overbuild out of massive excess capacity. So you start off with this supply constrained dynamic. Markets do what markets do, which is raise funding to chase returns. But then markets do what markets do, which is overfund. Returns get crunched and they create oversupply, and markets then sort themselves out and you get a few winners. And from our perspective, if we look forward around where the returns are made post that stage, it's generally those that build on top of that infrastructure that then start to accumulate the highest returns and offer the best risk reward. And we think crypto is approaching and going through that inflection point now.
So your thesis is that we probably overbuild block space?
Yes, and it's overvalued. So I think, we went through a period of Ethereum being built with a whole lot of prospects around how it would be used. Then a bunch of other layer 1s, sort of earlier layer 1s like the Solanas and the Lunas of the world getting developed, with some variations around the Ethereum design on a whole bunch of different levels, but basically no usage. We then saw DeFi summer in 2020, right? And we went from a period of, Ethereum fees being a microcent to swaps getting up to $500 at the peak of DeFi summer. So that's clearly not conducive to a wide user base. And so we went from that period of concept to adoption, block space being kind of this idea that block space demand and supply being an idea that had never really been relevant before, to suddenly having this massive undersupply of block space And Ethereum was about 99.9% of the market. Fees skyrocket, user experience plummets, a whole bunch of developers, use cases think, well, hang on, go $500 per transaction. That's not making any sense for me. And I'm not going to get any users there. We start to see that trickle down to the other layer one blockchains, the early ones there, the Solanas, the Lunas, things like Avalanche. And we start to see usage there absolutely skyrocket, values skyrocket. Markets do what markets do. They start to fund a whole bunch of other layer ones as well as those returns start to accumulate. We start to get this build out of block space supply. The good thing is demand continues to grow. But I think, if we look now, what are we, three or 4 years post that, the market's been incredibly good at building out the supply of block space. And in our view, it's built it out much faster and at much bigger levels now than we can see around any potential demand, over the medium term. And so we've seen fees plummet in that environment across most sort of use cases, which is great. Now, again, going back to my earlier disclaimer, investor versus technologist kind of mindset, that's what you want for cryptos to succeed. And $500 to do anything in crypto is kind of not going to see it go anywhere, right? So we want fees super low to allow people to build all sorts of crazy stuff, right? And to sort of throw mud against the wall and see what works. And so, that's part of the Solana success, right? It's kept super low fees. And so people can develop crazy use cases. A whole bunch of them end up actually becoming pretty realistic in generating material revenue. But in our view, we're in an oversupply of block space, and we're in with the development of layer twos, like we've seen, we're in a world now when people can spin up block space at kind of the flick of a switch, right? So we think it's unlikely that we see any kind of, will we see any sort of shortage of block space anytime going forward. And that means we're in a highly constrained fee market for, the cost of block space.
Does it condense down to a group of high quality block space and everything else disappears? Is that, how it has to consolidate?
Yeah, I think our view remains that there will be multiple blockchains worth a whole bunch of money, but they'll offer different things to different users. Now, you could argue, and this will probably be a little bit contentious, that Bitcoin's kind of the first example of that, right? Like, in an alternative universe, Bitcoin could have gone through a whole bunch of transformations to end up being some form of smart contract chain, right? But the reality is it found a use case, which is money, or, a store of value. That use case is so incredibly valuable that the incentives and the cost to experiment with any smart contract platform kind of doesn't make any sense because it's got its use case. It's found what people want to use it for. And, the good thing for Bitcoin is that's a super valuable use case, right? So people move on to Ethereum, and then Ethereum finds its use case, which is, people that want to build, I'd say, are willing to pay for security and a whole bunch of other things, I guess, that and embeddedness that Ethereum offers. But that's not everyone, right? And then along comes Solana, and people want to generate NFT issues at micro fractions of a cent, or want to issue meme coins that cost close to nothing to kind of issue 1 billion tokens. And, that's something you can't do on Ethereum. So it grows a market around that. And so you'll see multiple versions of that. I don't think it's an endless use case, and I don't think there's, hundreds of blockchains, but I think there's definitely, probably in the tens that can get communities that are specialized enough to sustain the ecosystem around that protocol.
And how do you explain the Lindy effects of blockchains that never get used? EOS would be an example. It's probably still got hundreds of billions of dollars of market cap, and yet it remains almost totally unused. I choose EOS because it's not going to get us into trouble like discussing some of the other one because I'm a coward.
Probably still will, but
it probably still will. But you know what I mean? It's like, how does that work into this? How does it become a meme or a community that still creates value without any use of the block space?
Yeah, I think we've got to be. Crypto is still probably the most inefficient market in the world, right? So if we, and you've also got to think of the structure of blockchains as an asset and as a construct is completely different to a company. Like a company requires funds to continue to operate, or it goes bankrupt and winds up. The concept of a blockchain going bankrupt doesn't kind of exist, right? So, because as long as someone's willing to run validators or nodes or whatever it may be, it can live forever. And so there'll always be like some penny stock or something somewhere. There'll always be someone willing to, trade it somewhere to give it some value. Now, some of these protocols that have no use case today have been around for a while and, frankly, in my opinion, have no use case going forward. I think you got to put that down to market inefficiency, that they're still trading those sorts of values. Now, the fact that they're still around, they're still trading doesn't surprise me. The fact that they're trading those values, I'd put down to inefficiencies. I don't think that's sustainable longer term. But look, as investors, it's part of the asymmetry of crypto, right? People that have got some of those investments wrong, to be frank, have been able to exit those investments without losing their shirt, which, again, goes to the inefficiencies in the crypto market. But I don't think that's sustainable as it starts to sort of mature over a 5 to 10 year view.
So as you start switching out of Bitcoin, you're looking at the applications layer. Let's talk about how you break down the applications layer, and then we'll dig into what you think is interesting there.
Yeah, I think we start with a macro view that, look, let's close off on the protocol layer first, and I guess why we start to push this way. I think there's three ways to value a protocol, right? There's look at it at a cash flow level on fees. You look at it as providing security for the activity above it. So that's effectively, the TVL that it's secured, that's chain secured. And then the third and most elusive and hardest to value, but that sort of real crown, the monetary value, right? And what we've seen is from a cash flow perspective and a TVL perspective, or the security to TVL, the vast majority of most protocols don't make a bunch of sense to us because they're trading at multiples circa 400 times cash flow and material multiples above anything that's required to provide security there, TVL. And in some instances, and this is where I might get a little controversial, Ethereum's fees haven't grown for 3 years, but it's trading at a multiple of, it's trading at a multiple above 200 times, right? So there is, even in the wildest of tech stocks, it's pretty hard to kind of justify a 3-year no growth profile at a 200 times multiple, right?
So I built a different valuation model for this I want to throw by you, which is Metcalfe's law. So I use Metcalfe's law to value the networks. And what I tried to do was approximate the value of the protocols. And what I got to was 2 variables only that explain most of it. One was number of active users, let's say in a month. Okay, that makes sense. So that's the nodes on the network. And the other was how much value was transacted by those nodes on the network. Using those 2 things, I just multiplied them out. They produce almost identical charts to the price chart or the market cap chart. So then simplifying it down, it's like, well, this is why Doge has huge value, because it has a bunch of active users, but no value being transacted except the buying and selling. Ethereum has a lot of users, a lot of activity, and a reasonable amount of value because of all the applications layers being built on top. And I'm not sure how people accrue the layer 2s, but I just assume it accrues to the layer 1 in terms of the use of the chain. Bitcoin, because it just does big transactions amongst a number of people, I found that was the easiest way of explaining it. And much like we couldn't value Amazon, I mean, you were a tech analyst back in the day. I remember it was trading back in, 2012 at a P of, 2015 at a P of 800. And because it was valued as a Metcalfe's law, it was a network and not a cash flow business.
Yeah, but over time it becomes a cash flow business, right? There's only so long the market will look at momentum.
That's right. Until the network adoption has peaked, then it starts going to cash flow.
Yeah, and I would argue that with 3 years of stagnant fees, you're looking at an adoption looking relatively mature, right, to a degree. And the ability...
Yes and no, because we need to think about the layer 2s within this, because I kind of feel that, and look, this is contentious. Nobody really knows how these layer 2s fit in. But there's the accrual they have on the base chain. Okay, fine, from the security layer.
Which is only a fraction of what it would be if it was on Ethereum chain altogether, right?
But
which is a dilemma.
What you've done is built a much larger infrastructure, i.e. it's underperformed this cycle because they've overbuilt infrastructure. But I think the finance industry probably will only go to Ethereum because it's secure. It's like the IBM or the Microsoft of blockchains, and it's likely to be the place where it goes. So they may have overbuilt in the short term, but maybe it comes back.
Yeah, but it's trading at $440 billion. Right, so
it is.
It needs to be. It needs to have things like that happen.
You're not including the layer 2 fees, so you're looking at it as Ethereum and not as EVM.
But that does include layer 2 fees. So, but if you look at layer 2, see, this is one of the problems, right? So layer 2s basically created the dilemma of, Ethereum's bleeding market share to other blockchains because fees are too high. So there needs to be solutions both on the main chain to lower fees, and they've been good at putting through various changes at a tech level that have, brought fees back down to a more, what I'd say, sustainable level or a more user-friendly level. With the other angle being, proliferation of layer 2s to effectively take away so basically effectively exponentially grow block space above what's on the main chain, right? So you've had that dynamic play out that we started talking about earlier, where you've seen the significant growth in block space supply to effectively dampen fees, which at the end of the day is the key competitive mechanism in the market to make sure that Ethereum kept grabbing at least some users, albeit a bunch of that is on layer 2s, and we're seeing that on base play out now. The problem is that cannibalizes fees that get paid to Ethereum and Ethereum holders. Now you might say, well, who cares? It's not a cash flow asset, but it needs to be somewhere, right? Like there needs to therefore be, and this is where I think Ethereum, from our perspective, got into a little bit of a little bit of a narrative issue. You come up to the merge and it becomes, the burn, it's deflationary. Let's look at the cash flow numbers, which were pretty good going into the burn. The problem then, fees start to tick up. Solana starts to take share. Avalanche, all those other chains start to grab share. Layer 2s proliferate. Tech changes bring fees back down. All of a sudden, you focus the market around cash flow. Cash flow has been flat to stagnant now for 3 years. Well, it needs to be monetary value. Well, the problem is we'd be very much on the skeptical level of the ability for many crypto assets to build any core monetary value because, through history, you'd see when people are free to choose what they use as money, they congregate to one or two things. And that makes a whole bunch of sense because you want it liquid and you want it widely accepted. And, gold and silver and the other precious metals never are looking for money. And, we'd argue that, I think it's a pretty easy argument to make. Bitcoin won that race in crypto, right? It's the money of the crypto sphere. And if
but it's not transactional money. Well, arguably ETH still has transactional value.
Well, then, the second place we would say is, if you're going to look for second place, if you're going to look for the silver in crypto, it feels much more like US dollar stable coins. And that's where you start to get into the transactional value that you just raised. So, and that's the perfect example of people choosing money and congregating around one. Like there's no set reason that US dollar stable coins are the 99.9% of stable coins, right? It could have been the Swiss franc. It could have been Hong Kong dollar. It could have been the Aussie battler, right? But the reality is that people had a choice in a free market, an unconstrained market, and everyone congregated around one US dollar stable coin. And from our perspective, when we look at the two forms of potential money in crypto, Bitcoin's kind of the king in our view, and it's one that sort of crypto native monetary value. And these things become self-reinforcing, right? And you get incidents like you do in 2023, the Silicon Valley Bank collapse where Bitcoin performs super strong and these narratives become reality because, it starts to perform that way so many times that becomes what happens. And if there is going to be a second transactional money, which fills in that case that you sort of rightly raised, people aren't buying milk and butter with Bitcoin. Well, they are with stable coins, right? And so stable coins sort of use that sort of silver we don't think there's much room left for an Ethereum or a Solana to have that sort of monetary place or that monetary value, which brings us back to TVL and cash flow needs to be that sort of long-term driver of their sustainable value.
And, okay, that's the supply side. Most commodity analysts miss the demand side. Generally, when I watch people analyzing the oil markets or anything else, it's always about supply because it's measurable, and demand is harder because you have to look at macro factors. What is the demand story here to suggest?
The demand story is insane. Like the demand story is great. It's the question of, again, putting the investment hat on, who's going to capture that demand? And when we look at something like, say, for example, Iridium, right? You know, the swap engine on Uniswap, volumes on Radium over the last 12 months, 2024 versus 2023, are up 44x. So there's your demand story, right? Radium printed for its token holders. So in terms of actual money returned through buybacks of tokens, $17.5 million in December alone. So you're talking about an asset that is trading on, to use old terms, on cash flow multiples, actual yields, if you're going to use buyback as a yield, sort of mid-teens. And where can you buy a tech asset? You're probably closer to equity markets than me and have a broader spectrum of coverage. What tech assets delivered 4,000% growth year on year and is trading on a PE of 14? I mean, it's just non-existent, right? Like, and from our perspective, we're our view as investors, we have to find these inefficiencies. Now, the great thing is these inefficiencies exist in crypto. The bad thing is they can take a long time to work themselves out. But it's our view and our investment style is to be patient and wait for these things to be sorted out, and for the market to say, well, hang on, how can an asset grow 4,000% and trade on a PE of 15? Like, that's not. There's enough money that'll come to the market over time that'll say, well, why aren't I allocating tech capital to an asset like that if they're the sorts of returns I can get as a token holder? And with the added benefit of, with a certain election result late last year, the transparency around the ability of these applications to return that sort of capital to token holders looks a hell of a lot better than it did 3 months ago, right? And so the risk of that revenue not coming back to me as a token holder at some point, and assuming that the incentives between the team and the owners of that token and then the community are way lower than they were pre-US election.
Yeah, that becomes really interesting because there's a lot of tokenized assets, particularly in the DeFi space, that couldn't distribute money, yet they were making money. So the token had no real purpose. Utility is the term for a token with no real purpose yet, but it's kind of there ready. But it kind of opens up a whole bunch of opportunities, particularly in DeFi, for exple, before we even go into the other applications.
Radium's a good example of one that's ahead of that in terms of they actually doing a buyback and burn, right? So, the same as JP Morgan buys back stock and Goldman buys back stock and Amazon buys back stock. They're buying back, and it's the standard, most efficient way to return capital to a asset owner in a diverse user base or diverse holder base, which is across different jurisdictions, which is what crypto is, right? So we've had some trailblazers that have kind of plowed ahead without regulatory certainty and put these mechanisms in place and shown that it can be done. Whereas we've got others that now probably have the certainty or will have the certainty as we look sort of forward a year to be able to put those sorts of mechanisms in place. Now, it's not always going to be the perfect model to do because you've still got to balance, is it right that we return that much capital to token holders or do we reinvest it effectively in growth, which is the standard sort of growth decision that, people have in equities, be it, fast growth industrials through to tech, right? But for a lot of these apps, they're starting to get that sort of stage of maturity. They're starting to generate cash flows that are far beyond anything they need to do to sort of fund future development and those sorts of things. So it does feel like the right sort of time to have these sorts of mechanisms in place to start to return some of that capital.
You see some really interesting businesses now starting to get much closer to maturity in DeFi, Aave being one of them, for example. I don't know if they sort out their token economics in the end, but it feels that the institutions, the finance industry, others will start using these in a broader sense now because of the regulatory clarity. And that's a big deal probably because most of these are cash flow positive businesses or cash generating businesses.
Yeah, and in a material way. Aave trades again. And, the amount of capital, the amount of fees generated on Aave, you're talking close to 100 billion, right? So again, significant revenue assets, trading, generating fees well above most protocols and trading that probably 2 or 3% of a whole bunch of protocols values, right? So that also goes to kind of, I guess, another sort of underpinning of our thesis. If we look at market share over time, and Aave is a material holding across our funds as well, so it's a good one to talk about. That if we look at cross market share over time, we've actually seen the core apps, the Uniswaps, the Aaves, even some of the ones on Solana like the Radiums and that, we've seen them actually hold their market shares incredibly well. And more importantly for us as an investor, they've held their fees. They haven't had that dilemma that an Ethereum's had where fees have gone up as cash flow has gone up and they've bled users to other chains. So they've had to put mechanisms in place to smash those fees down to remain competitive. The Aaves and the Uniswaps of the world have been able to maintain those fees and maintain market share, which for an investor like us, that's what you want. You want the investments that you make to deliver utility to the users, that your users will continue to pay that utility with the perfect outcome that you can grow users and hold fees and grow revenue, right? And then you need to participate in the overall ecosystem growth. And we've seen apps across the space be much more successful at doing that versus protocols, which kind of feeds into our thesis. And we're starting to see, particularly now across some of those core, what we'd say, building blocks of DeFi, we're starting to see them start to even further entrench their position. They've gone through, they've got 3 to 4 years of history now, the Uniswaps and the Aaves of the world. So they've gone through cycles. They've had a whole bunch of competitors throw things at the wall to try and take market share from them, but they've kept their dominant positions. Albeit, there's still good money to be made for others out there that can pick off or try different models, but they've kept pretty dominant positions and they're now in that enviable market segment where people start to build on top of them, which further entrenches their role in the ecosystem. And they start to also build that kind of B2B type use case versus just a B2C where they started. And you start to see, as you've alluded to now, as you'll start to see traditional finance come into the space and start to use these apps for what they're good at, which is, processing transactions at high volumes at super low fees, start to build on top of them. You'll start to see them sort of scale that use case and scale that user base and be that sort of entrenched kind of infrastructure at an application layer that's both built on B2B and B2C. And that's where we start to see that explosion in growth on those apps.
What's the story of Hyperliquid? Because that's a combination of the two, right? Isn't that both a layer one and a DEX?
Yeah, we'd argue much more an application than a protocol. It's got a protocol that kind of suits the use case, but people are using it for the functionality that it offers to them as an app, right? As an app specific protocol. So that's probably the one example of an app that trades at a super multiple. And again, controversial. Some of that would be justified because it is a killer perps exchange, right? It's been an incredible taker of market share and builder of a core user base. Again, that one just comes down to what's that worth as we project longer forward in a highly competitive market, which perpetual swaps are. I think, today that's been a super successful app at building our close to centralized exchange experience. And that's the secret to its success. I think we look at it, when we look at it across the space, we're nothing but rooting for the success of Hyperliquid for a whole bunch of reasons. One, because I think it's just great for crypto when applications succeed. Two, to show the value that applications can generate. Hyperliquid today is trading at a value of sort of 25 billion. We think that's kind of the first kind of example we're starting to see of that correction of protocol versus apps, right? That Hyperliquid can show that applications can push through that kind of $1, $2, $3 billion level and start to kind of push up and go above what, broad use case protocols can be. So if anything, we'd say that's kind of one of the first examples of that sort of breaking the ceiling and that kind of reversion of sort of valuation accrual now moving across to apps, or investment returns moving across to apps for protocols.
And when you're looking at apps, what else is interesting to you outside of the DeFi, or even within DeFi? What else is interesting to you?
Yeah, I think where we looked across where we've got exposure across apps, it's the core DeFi native applications, which are just showing just insane growth rates at sort of crazy, what we'd say is industrial sort of brick manufacturing multiples. I think the other thing where we're getting super excited, and I don't know where your head's at currently, but is across AI, right? I think that's probably the key thing to come out of December. Price action was kind of disappointing from a disruption and development perspective. Probably one of the most exciting months we've seen in the last 5 years in terms of just that explosion of activity around AI and use cases, and just that overlap between crypto and what I'd say is Web 2 drive into AI, which I just think is just probably just the most exciting place to look over the next 12 to 24 months for like killer growth in crypto.
Yeah, my view on this still, I'd like to get your thoughts, is that what we're seeing is not really AI. It's kind of chat wrappers. It's kind of a bit forced. But I understand that this is the seeds of ideas. We can see where it's going, right? It's fucking obvious that these things are all going together. But I just don't think what we're doing now is really it. Setting up a pump.fund for a bunch of chat GPT wrapper AIs doesn't feel like that is really agentic AI that is going to completely transform this space.
No,
not until you can say you can operationalize some of the stuff you do in the fund to an agent and say, hey, listen, what I want to do is I want to find the top 3 of these with this kind of valuation. I want you to execute that and stake that and do this, and it can go away and do it. That's agents.
Yeah, I think we're starting to see the early stages of that in the execution level. Projects like Biconomy or Synapse building sort of those AI-friendly execution layers. Now, it's still super crypto native in their examples. It's right, instead of, logging onto a platform and entering contracts and that sort of thing, it's, using AI as effectively an overlay to, go and buy me this many tokens at this price. And that's a massive incremental improvement for the native crypto applications, because you start to offer a whole, normal people that have much less familiarity with crypto can start to use that, right? Because you start to put an AI functionality over the top of it, right? So that's a huge leap forward just for crypto. When we look across more broadly around how AI moves and interacts, some of it forced, but even the less forced stuff, it's moving at speeds and moving at such digital native type aspects. It's impossible to see it not using crypto, either as a transactional layer or communications layer or development layer or whatever it may be. And even things like, Goatsy, which started off not as a crypto thing, naturally found their way to crypto, right? So that's not forced in any way, right? That's two solely digital ecosystems finding themselves together and finding use cases or finding things that they can do that are efficient and fast. I mean, the reality is it's impossible to see AI agents or AI entities, whatever they may be called going forward in the future, interacting in the traditional transactional rails we've got today. It's just not going to happen, right? No. And it's just so obvious that crypto is going to be those interactions. And it's not just financial interactions. I mean, the reality is, if we look forward, and Mark Andreessen did a great summary of this. If we look forward to future elections, if you look forward at the speed of AI, generative AI media, right? The ability for people to create fake media at this point is just exponentially growing day on day, right? So the reality is we've gone from what sounded like an insane use case 12 months ago, which is using crypto to effectively validate that you and I are both real in this interview, and you're not just an AI replication of yourself and I am. It sounds like some bizarre concept for 10 years' time, even 12 months ago. To today, they've been absolutely real, right? And the reality that people are going to have to prove that they are real and not fake. And that's going to be a real use case that crypto and cryptography can solve.
In 2021, I went round and tried to get a meeting together with the Web3 teams of Google, Facebook, Microsoft, LinkedIn, Amazon, to say, AI is coming. You guys are going to get sued into existence by the US government like a cash machine because of the spread of false information, and you need to have digital identity. And what was interesting is they're like, yeah, we all agree. I said, let's all get together and see if we can decide what that should be. And they said, we'd love to get together and talk about it. We will never agree. We said, why not? Because Amazon will not allow Microsoft login. It's as simple as that. They won't accept a token exchange on that. So it's like, wow. And then seeing Worldcoin, which is a fascinating, much hated project, but Sam Altman knows what he's doing. And the fact is, he can see where this is going, is you desperately need not only proof of humanity, but you need proof of AI too. And we're starting to see that on Twitter now, where you've got, it's listed as a bot, automated. And we have to do this.
Yeah, or proof of, as your revenues start to skyrocket in what people are paying for in AI, proof that their model you're paying for is the one that you're using. So the ability, and we've got an investment at the VC level in a project called Inference Labs, which is focused entirely on that, basically providing proof to me as a user that the model that I'm paying for is a model that's actually doing the work that I'm paying it for, and it's not some cheap imitation or whatever it may be. Now, again, when we made that investment, that was a pretty big leap of faith, but it feels a hell of a lot realer today than it did when we first started deploying capital.
Because if you look at Perplexity, they've got like 10 different models, and you can choose, and you don't actually know what you're getting. You're taking it for granted.
Yeah, and that's fine in the early stages, but you just start to move more down a compliant, commercial, business-driven user base of people that are saying, well, hang on, my budget for AI spend is 10 million this year. I need proof that the models that I'm spending 4 million of that on are the actual models that are doing the work for me and delivering the results, not some sort of cheap imitation, right? And so you start to see use cases again, and this is why, being in tech is, and particularly in crypto, is so exciting. You start to see these things take shape literally over a month, and you start to see things go from these kind of bizarre concepts that would confuse most normal, that would confuse 99% of the population, to one where you can really latch to a use case kind of now.
I'm also thinking, and I could be wrong, but somewhere in my head, it feels that there is obviously going to be a battle over what governments will try and allow for AI and what they don't want. So, and there's the battle between centralized and open source. It feels that model weights might, or the algorithms themselves could go on blockchain as a way of cementing them, securing them forever. That
I think
immutability of that might well be very important.
Yeah, no, look, and it's a little bit of a tangent and probably a controversial one, but unfortunately, as banks have kind of shown, as banking industry has kind of shown, unfortunately, we're in industry structures now where regulatory regimes and regulatory moats are a real business protector, right? And a real profit driver for those that can be inside the moat, right? And I fear that AI is moving down the path of seeing that model and yelling for more regulation as a way of effectively protecting itself from new incumbent entrants. And for people that like innovation and for people that like low fees and those sorts of things, that's the last thing we want to see happen. And with the greatest respect to my former profession, and banking is not an industry that's high on anyone's list for innovation, right? And that's partly because the regulatory modes are so insane. The cost of launching any new application or any new concept in banking is so vastly high that only the biggest balance sheets can effectively do it, and that stifles innovation, and that stifles change, and that's partly the reason we're on this talk today. That crypto filled some of that void in terms of a new sandbox for people to throw stuff at a wall and see what can be done when you sort of remove some of those limitations and allow innovation and technology to sort of take their own sort of paths unconstrained from these huge regulatory barriers. I fear that AI might go down that path, that we might see, and I hope it doesn't go that way, that we might see, governments sort of step in from a regulatory and a fear perspective and start to provide those sorts of moats. Now, the good thing is that we've got things like crypto that already exist and have been efficient at providing that sandbox outside that system. And so we'll probably hopefully start to see that kind of, that approach you're talking about, because I think the genie's out of the bottle now, and crypto can become that kind of sandbox if that is the case, and that can be where that sort of competitive.
Well, also crypto's so good at coalescing instant capital around ideas, testing it, blowing it up, or growing it. Crypto's pretty good with that massive kind of capital formation, rapid cycle. That's why it kind of is a supermassive black hole for anybody in the end.
I think that's that's one of the benefits of token models, right? Like we've talked a lot about valuation. The valuation, trying to value tokens and those sorts of things today, one of the other things to talk about is they've actually been super successful at what they were meant to do, which is build communities and rapidly scale and bootstrap things. And I guess that's another part of our portfolio that we think is kind of super interesting at the moment is around Deepin, right? And the ability for people to use token models to build out infrastructure or user bases at speeds that are just unfathomable from a Web 2 or traditional perspective, right? And using those token incentives to get people to do things fast at scale, that would be the envy of anyone in sort of Web 2 or traditional markets. We made an investment recently in a project called GeoDNet that's built effectively an RTK, which is a more refined GPS network. GPS has accuracy of sort of 1 to 5 meters. If you build a network that sort of aggregates GPS, simplistically, that aggregates GPS signals, a land-based network that aggregates those GPS signals, you can get it down to 1 or 2 centimeters, right? That's super useful for things like agriculture, mining, and particularly consumer, as we're starting to see that, consumer robots, lawnmowers, all those sorts of things that need super accuracy as we build out. Now, there's key players in the space that have had 20 years building those models, building out those networks, right? And they have okay global coverage. GeoDNet's done it in like 18 months. It's built out a network 5 times bigger than anyone else using those token incentives, because it's using one of the things that crypto is good at, which is effectively giving people part ownership of that network. They'll go out, they'll buy the tech, they'll deploy it as part of the network, and they'll do that for future token rewards, and they'll do that super fast, and they'll do that at global scale.
How do people hear about these things? Or is it the nerds that start and then tell their mates? I mean, how the hell do people, run the Heliums and all of this stuff, Hive Mapper? Where do they hear about it?
Well, I think that's the part of the benefit of a digital world, right? Like you're right, it's the core nerds that learn about it first, and you've got the added follow through of the economic incentives that the early adopters, and we've got a good track record now of seeing this in crypto, a bunch of early adopters make a bunch of money, right? So you've not only got the tech nerds, you've got the finance nerds as well looking for these opportunities, because the returns can be astronomical if you choose the right networks to do this. So you've got this nice sort of virtuous kind of ecosystem building mechanisms. And this is, one of the things that, again, that crypto gets a lot of negative press. A lot of the positive things that it's developed are these token models have been super successful at nameplate of what they were supposed to do, which is building the ecosystems like we're talking about. Like the concept of trying to do that, like I'll give you a small piece of equity if you go and buy this network, but you've got to go and KYC and we've got to put you on a register somewhere with Bank of New York. It's just not going to happen. Right? Like, it's not going to happen. Oh, we've got to stop all these jurisdictions from doing it. It's just not going to happen. Whereas crypto, you can do those sorts of things at speeds that are just unfathomable compared to sort of non-crypto world. And you're giving people a token incentive, which has been proven to be successful, and they're getting liquidity from day one, right? So the people, not that most of those early adopters want that liquidity straight away, the fact that it's there gives them comfort to invest that capital, right? And so you're starting to remove that risk reward. And so people, and we went out as part of our diligence and bought the Geode kit to be part of that network, spend the $600 or $700 to do that, and then start to earn the tokens knowing that, there's a decent chance of financial return here in a relatively short period of time.
And what other Deepin projects are you seeing that's interesting that are either live now or you're seeing in the VC? Because you've got two sides of your business, either the liquid side or non-liquid side.
Yeah, I think for us, grass is one of the biggest positions we've got in the firm. And grass
I've seen it. I don't even know what it is.
So simplistically, it's effectively a network of millions of people now that are effectively, for want of a better word, effectively farming the internet to build a live AI database. Now, there's some nuances around that. But again, they've effectively used a token incentive model to get people to download software that allows them to effectively build what in the short term is the holy grail of AI, which is a live database of the internet, right? You remember when ChatGPT and others first launched, they were running off 2-year-old models of the internet, which is kind of interesting but kind of stupid because a lot of things change in 2 years, and as we get to each new iteration, they get newer and newer. Clearly, we're moving into a world now where it needs to be live. Building that data set, to your point, going back to your point about getting Web3 companies together, they don't share their data, right? And so, the concept of someone just logging into Facebook and Google applications and Snapchat and those sorts of things and downloading data and being able to aggregate that is kind of non-existent because you can just get kicked off, right? But if you've got millions of users doing it at once, you start to sort of break that. And that's where Grass has been super successful at building what we think is one of the most exciting kind of live databases in crypto. Live databases in the internet.
Do you think there's going to be
using crypto incentives?
Do you think there's going to be databases where you get incentivized to share your private data sets, just random private data sets? Because obviously we're seeing the AI companies talking about hitting the wall and they're now using synthetic training to create new breakthroughs. But we know there's, whatever the internet is, there's like that all over again in private data sets all over the place.
Yeah, I think people have tried to do it a bunch of times, right? Like even from sort of, even in the early days of the internet boom, people were trying to monetize individual data. I think two things have happened in the last probably couple of years, even the last few months, that probably make it more realistic to be a short-term thing. The first one is the value of that data keeps going up, right? So as AI starts to show the value of live data sets and that sort of global reach on live data will be astronomical. And even today, people will pay a lot of money for that or for those data sets. And that's one of the things that we...
traditionally it's been the hedge funds who've been the big buyers, right?
Yeah, but these AI guys, they are massive. We're going back to where we started around supply demand. They are massive demand users for data. And we're going to get in this weird world where there's an undersupply of massive data sets, right? So the value of that's going to be huge. The second thing, the second problem people have had is how do you return that value to those people that give it up, right? And, sending people a couple of cents here and there kind of doesn't make much sense using traditional rails and all those sorts of things. And that's one of the other pieces where crypto has provided a solution where you can actually return value to people super efficiently at super low costs. And in a Grass instance, right, you're actually giving them part of that network. They can either monetize that value by selling those tokens effectively for cash, or they can keep sharing that network to ride the upside. And that comes at close to, fractional cost for Grass as a project. So it's super efficient. So you kind of add those two things coming together that I think make that use case you're talking about, which people have tried to sort of monetize to a degree at a broad scale for years, make it much more sense. And so you start to move to a much more democratized and a much more interesting and a much more philosophical, cleaner world where people are monetizing that data as opposed to it sort of,
which is the whole idea of
stolen,
Web3 right? In the end, right? It's control over our money, our data, our everything.
Yeah, which is where we started, which is where the internet kind of started, but unfortunately kind of got turned into a vast covert data capture operation and monetization outside of that by huge corporations. So Web3 is a chance to kind of recreate what was originally envisaged, I guess.
So what else are you looking at that's interesting? What are you seeing on the VC side where new things are happening? You're like, that's interesting. This might be something. It might be a new area for growth. Because there's still so many applications. We've all said for a while that the applications layer's still been underinvested and underdeveloped and
undervalued as well.
And undervalued. And I'm guessing at VC level you're spending a lot more time in applications layer. So what are you seeing?
Yeah, I think AI in particular, Deepin. I think probably the more interesting trend, stepping back from the actual specific projects, is how they get funding. And I think with the access to market, with the access to liquidity, we're going through what I'd say is kind of a renaissance of what we saw in the initial days of the ICO boom in sort of 2017, 2018, but with new clothes. And the amount of fair launches and the amount of the ability of people just to put a project, put a token up through a liquidity pool at close to zero cost. And put models in place that provide them funding to effectively build what they're building and effectively bypass that traditional VC market altogether. So I think what we're trying to, we're obviously still super focused around the traditional VC market and working with founders pre-token, but, we're a crypto native firm. We can't, we're a follower of models. We're not just sitting there with a dictate that you have to come to us and this is, these are the rounds of funding and this is the way you're going to do it. We love innovation across everything. Use cases to the way people are raising capital or the way people are funding projects. And I think what we've probably seen the last 12 months or even going back last 2 years is we've seen probably a trend back towards a less traditional VC market where a bunch of the most exciting things in crypto are happening direct to market without that sort of traditional round after round after round of VC funding. And so we're saying super nimble to sort of chase those opportunities.
One of the issues I've got with a lot of those, though, the ones that are fair token launches, is that the founders don't own much of these things. They kind of realize the value too early, and then there's a misalignment of interest. And we've seen this a lot.
Yeah, I think, again, there's a whole bunch of different models. I think the one, we have the same concept. You need for us to own a token, we want the people that, and we do a bunch of things on the networks to try and help from a value perspective as well. And, we're big users of most of the things we own. We're big users of Radium. We're big users of Camino, the sorts of projects that we invest behind. But then the people doing the development at the coalface, we want them to own the tokens as well. And we want that incentivization for them to grow and do their part of the bargain as well alongside us, right? So we've all got those same incentives. We have seen what we think is some pretty interesting models, right? Like something like a banana gun bot, for example, right? Where you've got money returned to the treasury and returned to token holders and through sort of initial taxes, tokens given to the teams that are based on usage and turnover, right? And that gives the initial allocation to the token holders, to the team there. And in that example, the team, I think, has got, a much longer vest than we'd ever see in any traditional VC type deal, with the added bonus that they used that because it was a successful project and part of the revenue was effectively funding their initial slice of the token, right? And so you start to see these cool sort of variations on a token model that create that incentive model that we like to see. And, get them to market super fast, get a token that they can help to bootstrap their user base super fast, and you use crypto what it's good for, which is helping to bootstrap and helping to build communities at speeds we've never seen before across any market.
One of the things I think you and I talked about in the past was one of the unique things about this space is the imbalance between the size of VC and the size of the liquid hedge fund market or the liquid professional capital market. And what you get is projects that are coming out at super high valuations, they come onto the market, they fall 90%, and it becomes a gift to the hedge fund industry because there's so few professional users of capital. There's still a real mismatch within the market, I think.
Yeah, there is. And I think that gap gets filled in two ways. One, growing retail appetite. Two, people allocating more over time to liquid funds like yourself because they see the risk reward there stacking up pretty well. And look, Hyperliquid's a good example of that, right? And Grass is another good example of that. They're token launches that have had much more of an IPO type launch trajectory, which is great for the space, which is, early sellers have been punished. And that's what you want to see. You want to see people move away from that model that the highest price is the price on day one, because that's a terrible dynamic and that fosters terrible secondary market behavior. And to be frank, that fosters terrible VC behavior because everyone rushes for the door.
I love it. When I see something getting nuked when it comes out because it's come out too high and you kind of get that low and you're looking for, is this a real project? Does it have demand? Those are the ones you can make a shit ton of money from. You get VC-like returns in liquid markets without all of the risk of being very early stage.
Yeah, and we've seen that, and it takes a lot of courage. And we'd like to think of ourselves as someone that does that courage. For our liquid fund and part of a fund we're actually raising for at the moment, that's exactly our strategy. We look to buy effectively secondary tokens from either VC looking to exit through a vesting period or even foundations and treasuries, where we'll buy those tokens, a lot of them in the trajectory that you're talking about, where we're buying effectively locked up tokens. We're happy to take a long lockup for a discount there with the view that we can sort of ride that sort of longer term growth. And they've been sold down to levels that don't sort of make a bunch of sense based on the growth that they can offer. Now, we like that market. I don't want you to advertise that too much because we like to be one of the only players in that sort of market.
There's a few people doing it. There is a few people.
It takes a lot of courage and it takes a lot of patience. And I think, we're fortunate enough to have a track record over a long period of time and have patient LPs that sort of see that as part of our strategy, that we look for those sort of inefficiencies and we look for the kind of these vesting periods can be 2 to 3 years, and we look for that sort of patience for those things to sort of work it out and try to sort the market noise, which is a dynamic you're talking about that super high listing price that then gets sold down from the actual fundamentals of things that are.
That's right. You're having the fundamental framework that you guys have really helps in that kind of risk taking, because you're not momentum risk taking. It's like, is the market undervaluing this at this stage on a forward basis or not? And doing that kind of work helps.
Yeah, I think from my personal perspective, it would be impossible for me to invest in this space without that. Because one, I want that underpinnings because I think it actually delivers the best returns. Two, you kind of need it as almost like a security blanket through the volatility that crypto can throw at it. Because if you're trading based solely on price in crypto, your mood changes about 7 times a day, right? So you got to have something that sort of looks through that noise and allows you to be patient. Because if I look through our sort of 6-year investment journey, we've never owned anything that hasn't had near-death experiences. Even our Solana position, which we still own a material part of, we entered that position at 22 cents. It's traded between 22 cents to $250 back to $8 back to $220, right? So if your valuation, if your approach is based solely off momentum, like you've sold out way before, and you've probably shot yourself in the foot 100 times in Solana trading through that period.
Don't your normal friends just think you're fucking insane?
Yeah, pretty much. People less insane than they did when I first started this business back 7 years ago.
I know, but just if you say to somebody, I bought something at 22 cents, it went up to $200. I rode it all the way back down to 8, and now it's back up $200 and something again.
We did sell a little along the way, and we bought some back Some of it well-timed, some of it not great timed. But I mean, you look at Solana, but that's the perfect example in crypto, right? Like you take out that short-term volatility and you go from a 22-cent entry to a $220 price today, and you go to a chain that was basically some really super interesting tech when we bought it at 22 cents to one today that has some of the most innovative, crazy stuff happening on it with millions of users and transactions that are just off the charts, right? And so you take out that short-term price move over that, when did we buy that in mid-2020 to today, over that sort of 4.5-year journey, the actual fundamental changes are just astronomical. And so the 22 cents to $220 looks kind of normal when you sort of stack that stuff up. And that's why you need that safety blanket to keep yourself safe. You'd remember back in late 2022 when Solana was apparently dead and destined to go back to what was the meme? The SBS $3, right? And
that's right.
It's just, if you live day to day in crypto, you can go insane. And so you've got to have something that keeps you sort of wedded to that longer term conviction that we're in tech that's growing at 44 times in a year, and don't lose sight of that sort of vision. Now, you got to live and breathe a bit of that craziness as well, or you'll miss things that sort of pop up super fast, like some of the AI stuff we've seen through December.
Yeah, and you've traded memes as well.
Yeah, and we've traded a lot more infrastructure around memes. We've been super active, and that's partly where our Radium position comes from, right? It's kind of the key beneficiary of, apart from Pump or Fump, from a token perspective, one of the key beneficiaries of meme trading and the rise of memes and an ecosystem we don't think is going anywhere, leaving us anytime soon. So
yeah, because on my Phantom wallet, I will switch Solana into smoking chicken fish or whatever it is, and it's Radium that it normally goes through, right? So
and it's all those tokens on Pump.fun that are generated flip into Radium pools, right? Once they reach a certain size. So
yeah, it's
got that incredible capture of that meme growth. And Solana, I don't know if you saw yesterday, Solana did more swap volume than Ethereum and Base combined, which is just insane levels of activity. But then there's other places like, that's the key driver of our holding in Banana Gun Bot. Again, a platform through a Telegram bot that generates huge utility to users that want to trade, first block memes. And that's a project that made $58 million in fees last 12 months, right? And I don't know, me mentioning it today on your podcast, on this discussion, probably 100x times the amount of people that actually have heard of it. It made $58 million in fees.
Staggering.
Users paid $58 million. And, that doesn't include the fees that it generates for block builders, right? Which I think were about 80 million through the year as well. So just astronomical amounts of capital. And I think that's why I kind of sit here today and talk about these apps and get super excited. The amount of people that sort of understand the amount of capital the amount of profits or the amount of revenue that's been generated by these crypto applications is extremely small. And we know there's a whole wave of people that will put as much capital as they can into something that's growing at 4,000x year on year at 15 times. It's just that the barriers for them finding out are pretty high, and you and I have the box seat to buy them before they turn up and these things get repriced to more sort of market normal levels. I mean, that's one of the other things that's over the 6 years, of sort of talking to our LPs and crypto and prospective LPs, there's been three key things that have held people back. And it's been, regulation. And, we've had a huge step forward in where that's headed over the last 3 months. And I don't think anyone's, if anything, it's turned to a positive for the space as opposed to just mere clarity. Tether's been an issue for institutional investors, and that's been off the table for some time now. It's disclosure and its transparencies and audits and those sorts of things. So that one's gone. And the third one is around, nothing in crypto makes money. Coming back to Tether again, it's probably one of the top 5 most profitable financial services companies in the world. And then I'm telling you, there's applications today making, $20 million a month, trading at, 15 times multiples. Now, the good thing is there's heaps of that being made. The next best thing is that there's hardly anyone that knows about it or is investing in based on it. So we've so far had this playing field largely to ourselves.
So final question, anything in AI that's investable for you right now at liquid token level?
Yeah, I mean, grass is a perfect crossover for us, right? So we'd see grass as that. We think Worldcoin's super interesting.
So that's AI adjacent because it's collecting data, but it's also Deepin, so therefore it has a valuation framework that's usable for you.
Yeah, and it's building a data set that's going to be bought by AI users, but by these AI, by the models, right? And so it's a perfect crossover of using Web3, which is what it's good at, to build a database that you can't use using Web2 or any other means at super speed, and then delivering it to people that have a lot of money to spend to buy these databases. So also focused around sort of more the traditional metrics that we want, that, something that's got utility that they can sell for money. I think in the AI space, we think Worldcoin and those use cases are super interesting. Early days for us there. We don't have a material position there, but we think that, that proof
Worldcoin to me
life
is really interesting. I've met them because they're here in Cayman. And we all got the narrative because of the orb, but really it just takes Microsoft to say, we will use that authentication, and that fucking thing gets re-rated 10x overnight. And that's what's in my head. Is if Sam Altman's going to push it, and he's got, whether Sam Altman ends up with power or Elon has robbed him of it, we don't know yet. But there's some sort of optionality to it.
Yeah, and I think if you looked at it, we looked at it a way that there's two hurdles you needed to kind of get through, right? The first one was, is that even a real use case? And I think they're gone, right? Because I think any kind of realistic view forward shows that proof of life, proof of realness is an absolute short-term use case that's here. If we went back 12 months, that was all still pretty kind of nebulous, right? The second one is, are they going to be used, and how does the token benefit from that? But look, you've had one of two things kind of drop away in our view, which make it a lot more interesting than it was. So if we looked across sort of our AI exposure across our portfolio, grass, we think, Arweave and what they're building in the AI, which is launching in February, remains super interesting as well.
What about Tau? I know Barry
we do have a material position in Tau as well.
Yeah, because I went to Barry's whole event recently, and he's like all in on Tau now. Yeah,
which is, I think, one that we came from a different angle, from the VC angle for us, that we just had time and time again the most impressive founders building the coolest stuff, or the coolest potential stuff in crypto, AI, crossover, while also playing around in the Tau ecosystem. And we just thought that kind of like that, almost like the sort of early days of crypto around, if you look back at the sort of the key, what became the key kind of foundational personalities in crypto were all around Bitcoin. They may not have just been doing Bitcoin, but they were around Bitcoin, and that became the sort of the ecosystem that drove the key founders that then sort of drove the initial sort of growth in crypto. From our perspective, Tau looks similar in that even people building things that are particularly focused on Tau still have some association or super interested or contributing to the Tau ecosystem. And for us, that was the push that kind of got us to take our position in Tau, is just that the amount of founders that we saw that were impressive in II, nearly all of them had something to do with Tau, either be contributing in some way, building on it in some way. And so it just felt like that kind of central point where crypto could launch from, and continues to be. So I think it's really interesting.
Yeah, because it's also utility, it's infrastructure, it's not just following a chatbot. I mean, this is a much bigger thing. It's complicated, though. I've sat down with the founders and stuff. It's complicated.
A lot of good things in crypto are, I think.
I know. They take a while to get your head around. Until you can get it down to a nice mimetic, It's really hard.
But I think one of the biggest early kind of pushbacks against Tower was firstly around inflation. But I mean, that's just standard crypto models, and that's what you've got to do to bootstrap a community, and it's been super successful doing that. Second one was, there's a bunch of what I'd say is super low utility stuff that was happening on subnets and those sorts of things. But that's just typical crypto tech. People throw weird stuff at things to see what sticks, right? And over time, you start to see the more utility-driven use cases start to crowd out those kind of crazy ones, or you see those crazy ones become real. And so, when we see that happening, when we see people experimenting with crazy stuff as well as pretty tangible stuff, that never turns us off, because that's what you want to see. Because, you don't want to come into these sorts of, Tower super complex, and what it's trying to build and what people on it are trying to build is incredibly, incredibly disruptive stuff. The last thing you want to come at it with is preconceived ideas around, well, this is what's going to work, and that's all I'm going to invest in. You want people to be doing weird stuff and see what happens.
Yeah, you want to be shocked by something that gets traction that you didn't even think of.
Correct.
Richard, super fascinating conversation as ever. Really good. Here's to a great 2025. Let's hope it's the year of the banana. And your banana bot goes up and the banana zone continues to happen.
Great to be with you again.
All right. See you soon.
Cheers.
So hopefully you found that interesting. Richard uses this kind of value framework for his crypto investments. And he looks for things that are undervalued where he thinks they should be. So it's not just so much a momentum trade, but he puts some real framework on it. So hopefully you too have learned a little bit about building a framework. My bets are more concentrated. Richard is broader and more diverse in his themes. Now, it's different horses for courses, different ways of making money. But for you need to learn your way. You don't copy me, you don't copy Richard. But you build what style is best for you. What's your time horizon? How much volatility can you stomach? Should you have a diversified portfolio, or should you keep it simple, stupid? I'll leave that to you, but I'm here to help. And hopefully I'm helping you on your path to unfuck your future.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.